Welcome to PhillipCapital's Weekly Market Watch. The US market has been experiencing upward momentum, sending S&P 500 to 18-month high at the end of March 2010, as the market regains its strength and moves towards recovery. However, its relationship with China has been a topic of contention for many investors. Today, we have Ms. Sarah Chen, CFD dealer from Phillip Securities, to tell us more. Recently, the US government delayed their verdict on classifying China as a currency manipulator. Any comments?
The release of this report will not be very beneficial to US-Sino relationship that is already under strain. What with Google pulling out of China over censorship issues in March, US President Obama meeting Tibetan Buddhist leader the Dalai Lama at the White House in February, and Obama administration notifying the US Congress of proposed arms sales to Taiwan worth $6.4 billion in January this year. U.S. Treasury Secretary Timothy Geithner has been urging China to move towards a flexible currency against a backdrop of pressure from U.S. manufacturing businesses, claiming that the yuan is undervalued and is hurting their businesses. Such a move comes with great repercussions. Investors got to be really careful. If such an act by U.S. is executed, it might result in a trade war between the two nations. Geithner is hoping that China will take its own steps to strengthen its currency to achieve a more balanced global economy. Should China allow the yuan to be strengthened, an immediate impact would be cheaper imports for net importers like US, though it would also imply that the cost of manufacturing products in China will rise and smaller profits for high-tech hardware companies.
With the major US stock indices showing promising signs on the economy, what are your views on the US market?
Well, in recent times, we see that the US economy has moved away from being manufacturing-led to having services pave the way for better than expected recovery. Since services is a major component of US GDP, together with better jobs data and increased consumption, the market is experiencing a boost of optimism. With more investments pouring in and fiscal policy supporting consumption, we expect more jobs to be created, and real wages have not really followed the uptrend yet. Now, if fiscal stimulus were to be pulled back, we may see dips in consumption. In the mid to long-term outlook, US economy is restructuring itself to an investment export industry and is positioned for growth. With the economy continuing to develop positively, raw materials and energy sectors would be natural beneficiaries of this improvement in market conditions.
How will you advise our clients in the markets ahead?
We are trading very closely to the psychological resistance of 11,000 for Dow Jones Industrial Average, while strong ISM manufacturing data has sent the S&P 500 testing 1180. We think that pullbacks in both indices would present opportunities for investors. However, investors should stay cautious at such significant levels, as there may be possibilities for the indices to break briefly through the resistance before correcting. Interest hike rates would also be a boost for the market to push beyond the resistance, as an increase it signals to the investors that there is real optimism that the Fed is confident the market is indeed recovering.
Thank you, Cheryl. That's all we have for you today. Tune in next week for more market updates.